Have you ever wondered why, in these huge established companies, so few people seem to leave and start their own business? Is it because the company just crushes their spirit, or is something else entirely going on? Well, today we're going to unpack that exact question. We're looking at a really fascinating 2012 paper from the Administrative Science Quarterly by Alexandra Kacperczyk, titled Opportunity Structures in Established Firms.
So here's how we're going to break it down. First, we'll lay out the central puzzle that the author is trying to solve. Then we'll dive into the two competing theories she's putting to the test. After that, we'll quickly go over the data and methods before, and this is the good part, we get to the core findings. And finally, we'll wrap it all up with the big takeaways from the whole thing.
All right, so let's start at the beginning. What's the big question that's really driving this entire study?
Okay, so the paper kicks off with a pretty well-known fact. If you work in a large, mature organization, you are way less likely to leave and start your own thing. And we're not talking a small difference here. The rate of people starting their own businesses is almost 3 times lower in big firms compared to small ones. So the big, lingering question has always been, why is that?
Well, this brings us to two totally different ways of explaining this. The first is the one we've all probably heard, this idea of bureaucratic stultification. You know, the classic story that big, rigid companies with all their red tape just squash any entrepreneurial spirit. But the second idea completely flips that on its head. It's called internal opportunity generation, and it suggests that maybe, just maybe, these big firms aren't killing ambition, they're actually channeling it.
And that is the absolute core of this paper, figuring out which of these stories is really true. Is the lack of spin-off companies a bad sign, a symptom of bureaucracy? Or is it actually a good sign that points to a wealth of internal opportunities? To get an answer, the author really digs into this idea of intrapreneurship.
So how do you even begin to model something like this? Let's take a look at the theoretical framework the author builds to test these competing ideas.
First up, let's just make sure we're all on the same page with our terms. In this study, entrepreneurship means exactly what you think it means. You leave your job, you go out on your own, and you take on all the risk for a brand new, independent business. Simple enough. Intrapreneurship, on the other hand, is all about being an entrepreneur inside your current company. It's about taking that exact same drive and launching new ventures, like a new product line or a new division, but you're doing it by using the resources and the structure of the firm you already work for. You're still building something new, just within the walls of an established organization.
Now, you might think a scrappy startup is always the best place for a new idea, but this theory points out some huge advantages that large firms have. I mean, they've got vast networks that can expose you to amazing new opportunities. They have systems already in place to sort through complex information and spot a winner. And, of course, they're sitting on a ton of resources, like R&D budgets and capital. And they have established routines that can actually support and absorb new projects. And right here, you can see those two competing ideas laid out as two really clear causal paths. Path one is that classic stifling argument. As firms get bigger and older, bureaucracy sets in, and that just kills the entrepreneurial drive. But path two presents the absorption argument. As firms get bigger and older, they create more internal opportunities, which reduces the need for ambitious people to leave in the first place. The entire paper really hangs on finding out which of these two paths is the more powerful force.
Okay, so that's a really neat theory, but how in the world do you actually test it? This is where we get into the data and methods. The study uses data from the U.S. mutual fund industry, which is actually a brilliant move. Why? Because launching a new fund is a really clear, obvious event, whether it happens inside an existing firm or as a brand new startup. The data covers more than 7,400 fund managers over a span of more than 2 decades, and it tracks every single one of their career moves on a month-by-month basis. And to measure the key factors here, the author keeps it really simple and really powerful. Firm size is just based on the total assets under management. And firm age is, well, just how long the company has been around. Now, to analyze all of these thousands of career moves, the author uses a pretty sophisticated statistical model. You don't really need to know the technical name, but what it essentially lets her do is look at a fund manager at any given moment and figure out the probability that they'll make a specific career jump, like starting their own firm versus starting a new fund internally, all while accounting for the fact that these are competing choices. Okay, so after all that setup, what did the data actually show? Let's get to the results. The results that came back were just incredibly clear. As expected, the bigger and older a firm gets, the less likely an employee is to leave and start their own company. But, and this is the absolute key finding, the bigger and older the firm, the more likely that same employee is to launch a new venture inside the company. The two effects are moving in perfect opposition to each other. Let's put some real numbers on this. A meaningful increase in a firm's size is linked to a massive 43% drop in the likelihood that an employee will leave to become an entrepreneur. But then you look at the flip side. That exact same increase in firm size is linked to a 54% increase in the odds that an employee will launch a new venture internally. So the entrepreneurial energy isn't just vanishing, it's being redirected. And to really hammer this point home, the paper looks at firm mergers. Think about it. A merger instantly makes a firm bigger and gives it more resources, long before the slow, grinding effects of bureaucracy can set in. And what did they find? These mergers led to a big jump in internal venturing, which is really strong evidence that it's the opportunity structure driving these results.
Okay, so what does all of this mean in the grand scheme of things? Let's wrap up with the discussion and the paper's main impact. Now, of course, no single study can answer everything. The author is very upfront that we still need to learn more about the exact ways that firms direct these internal resources, and that other things like a company's hierarchy could also be playing a role. And these findings just open the door to some really fascinating new questions. For instance, what's the net effect on the economy? I mean, do big firms actually create more new ventures overall when you count both the internal and external ones? And how does the performance of an internal venture stack up against an external startup? These are huge questions for future research to tackle. And that brings us right to the final, powerful takeaway. The reason big companies seem to stifle entrepreneurship isn't necessarily because they're killing the entrepreneurial will. Instead, it seems this negative effect is partly just a consequence of their positive effect on intrapreneurship. The employees in these firms aren't less ambitious. They're simply choosing to be entrepreneurial inside an organization that provides them with a really attractive alternative path. It completely reframes the whole debate, from a story of stifling bureaucracy to a story of opportunity.